Everybody wears shoes, and the company I'm covering today, I have called in the past the Coca Cola of shoes because let's face it, whether you're walking, running, or just chilling in your sneakers, Nike is the best well known shoe brand there is. However, their stock price has fallen dramatically in recent days, down over 33% over the last year. Many investors say that Nike has now entered value territory being this low. After all, at one point in time, it was trading for, I think it was $177 per share. So it's down majorly from those all time highs. It still trades at a PE that is above 20 and has a dividend yield of about 2%. This stock may not be cheap, but just because it isn't cheap doesn't necessarily mean it's not value if it has, for example, the growth to support that valuation. Now, while Nike may have a brand and moat, it does not have a tremendous amount of growth. Um, I think that also combined with this, we are looking at possibly a weak consumer. And with a weak consumer and the sticker shock of paying $100, $150, $200 for name brand sneakers, I think people will kind of shy away from that. It's a similar effect to what's happening in some cases with Starbucks, people sort of shying away from those $7 and $8 drinks during these tougher times with maybe price inflation causing some problems for the consumer. And here we have Nike's free cash flow. So this is certainly not a clear growth trajectory in their free cash flows. There's probably a cyclical element to it, but it's certainly not something that I would rate as like super predictable and easy to model for consistent growth. And the question I would have is, does this justify paying a premium valuation? I have a hard time getting there on this one. This just doesn't scream pay a premium valuation and this, what are you getting for it? It seems like you're getting free cash flow that bounces up and down, but is more or less flat over the long term. Now, I will give them this. Their balance sheet is quite good. It's pretty strong. So this is their net debt. So they have a lot of cash on hand. So they could pay off all of their debt with just the cash that they have on hand right now and about 1/4's worth of free cash flow. That's kind of an average amount that they might get in free cash flow. So that they would have to suspend the dividend and stuff to do that. Speaking of the dividend, pretty modest payout ratio of 43.5% of net income with a dividend yield of 2% and a buyback yield of 2.45%. The question is, are those buybacks always really accretive, considering that this is still over a 20 PE with kind of minimal growth, I would think. Now, if they got a lot cheaper, I would say, yeah, turn up the buybacks. The dividend growth, if you're focused on that, is pretty good at 9%. Now, analysts seem to think that the low 70s is maybe a touch low for this company, with the low target for the next 12 months of $75 and a high of 136. I don't know what the analyst that put it at 136 could possibly be thinking, as that is close to double today's price. So what, does Nike just deserve a 40 PE just because it's Nike? I can't see the growth justifying it. Like that's like a tech valuation, a tech that's getting decent growth with really high margins that are much higher than Nike's. I don't understand that 136 at all. My own personal view is I would want this probably in pretty deep value territory, meaning I would want to jump up the discount rate on what I think they can realistically do to 12% in order to consider a name like Nike, because the growth is limited. So you have to get your gains, I think, from low valuation. And I think in the 60s somewhere, probably low 60s. I've said off the cuff before 60ish. I think that's where you probably get that low valuation where it could start to be worth it. Then at that point, you can say, okay, yeah, it does have the brand. There probably will be some growth, but not like crazy awesome growth. Especially, after a dip in their income, they probably will have like a bounce back effect of some kind. And of course, yeah, they have a pretty good amount of assets on the books. I'll credit them for that too. And this isn't to say that you'll lose money buying them at today's price. That's not what I'm saying. But I don't know that you'll be super impressed with your return buying them at today's price over the long run, unless they have some other stupid, crazy run up to some unrealistic price. But I don't think investors should count on that necessarily. Be sure to comment below if you own Nike, and make sure that you thumbs up the video for the algorithm, subscribe for more, of course, and make sure that you follow me on Twitter at Mr. Macho Mog, link in the description. Join the Discord, link in the description, where we discuss stocks like Nike every single day. And don't forget to catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live, link in the description there as well. Take it easy, everyone.